Chapter 35, Insurance. Protection for a rainy day, protection from loss and liability. This chapter is very apropos for the circumstances that we are going through right now. We have lots of businesses struggling, and they are probably experiencing a lot of loss. In addition, individuals are suffering and maybe experiencing, in addition to personal loss, also monetary loss. And this is exactly what insurance is designed to help lessen, to protect people and businesses in the situation where they are experiencing an unanticipated loss. And so insurance, as I've mentioned throughout our course, is really what helps businesses to function well, because to the extent that you know that you can purchase insurance and you do, what insurance allows one to do is to lessen the risk that they take on. It allows them to share the risk with a third party whom they are paying to do so, but who will come in and help them absorb catastrophic loss. So let's look at that in context. The parties. So who creates a contract? Well, the insurance company is considered the promisor. They are the one making the promise to the insured that they will pay under certain circumstances. So the promisor is the insurer or underwriter. That is the insurance company who's insuring your business, your property against a loss. The promise is made to the policyholder or the person who takes out the insurance contract, who is known as the insured. Probably all of you have some sort of insurance policy, if for nothing else, on your car. If you have a car, somebody's got an insurance policy on it, be it you or your parents. And the company, say it's Travelers Insurance Company or Geico or Progressive, they are the underwriter of the insurance. They're also known as the insurer, and they are promising you that they will pay you the limits that are in the policy upon the happening of a defined loss. That loss is described in the contract. Insurance contracts are called policies. Now, how do you get an insurance contract? Well, if you go to a person who works for the insurance company that you're getting your policy from, then you're using an insurance agent. You see them everywhere. State Farm has tons of agents, and you'll see their offices throughout the city. An insurance agent works for one company. They work for the company whose insurance they are selling. And so they are representing the insurance company's interest, and that's whom they kind of owe their allegiance to. So you need to think about that when you're dealing with an insurance agent. They are not working on behalf of you. They're working on behalf of the insurance company. They're their salesman. So you got to think about it. It's just like if you were going to a car dealership, you realize that the car salesman is trying to get the best deal for the automobile company, not you. And that's the same case with an insurance agent. Now, you also have an option. You could go to someone who's considered an insurance broker. How will you know? They have to designate themselves this way. They have to, it'll be on their business card, it'll be in all of their materials, whether or not they are a broker versus an agent. But the main way you can tell if you're working with a broker is that an insurance broker will have lots of different insurance companies to choose from. They won't just be selling one. You would go to them and they would say, okay, well, let's take a look at, given what you want insured, what the loss is you're trying to cover. These are the different companies. These are their different plans. Let's look at which one would fit your interest. So they've got, say, a menu of different companies that they can offer you. So they're an independent contractor. Now, how does this affect you in terms of whom are they representing? So an insurance broker is to some extent, they're going to be a little bit, they don't owe all of their allegiance to one insurance company. The insurance broker isn't just going to try and sell you State Farm. They're going to offer you State Farm, Geico, Progressive, Aetna, Travelers. They're going to offer you any company that they happen to be licensed to sell. So they still kind of have some sort of allegiance in the sense that most brokers, they're not under contract to sell everybody that's in existence. They've got a few companies that they've got relationships with, and they will offer you sort of a menu from here's what we've got, let's look at what you want, let's see who matches up best with you. So they're an independent contractor. Now, once you give them your premium payment and say, I'd like you to get me a policy with Geico, as it relates to paying Geico and getting that contract together for you, then they're your agent. They're working on your behalf as the insured. But I want you to realize it is not they're not your agent the whole time. They're still only showing you what they are personally available to sell to you. So what's the best option out of what they have to offer, not necessarily what's the best option for you completely if you were to look at everything. So as an individual, I would say to you, it behooves you to do your own research online to figure out which insurance agency you might want to go with, because once you call an agent, someone who works for that company, they're going to try and convince you that whatever they've got is the best for you. So because they're working for that company. If you call a broker, you're going to get a little bit better situation. You're going to have someone who's not quite as biased towards one company, but they're still going to try and sell you one of the companies that they have a relationship with. So I would suggest that when you're looking for insurance, that you Google yourself their different rates, because all of that stuff is available, and kind of narrow down who you think you'd want to use. All right, let's look at what you can insure. And so these first few slides, everybody, are just the general principles that apply to all types of insurance contracts. Later on, we're going to look at particular types of insurance contracts. So what's the insurable interest? We've talked a little bit about this earlier. We were talking about who has the insurable interest of goods during transit. Like whose are they, so that you could get an insurance contract. Now we're going to kind of broaden that. I was very narrow with that definition earlier. The insurable interest as it relates to insurance can several parties can have it. For instance, so the insurable interest exists for anyone for whom destruction of the property would cause a direct loss. So it could be that there are several parties whom would suffer if the insured property is destroyed. I'll give you an example. One of the best examples is, say, your house. Everyone, eventually, when you buy your own home, you're going to have to get homeowners insurance on the property. And I say you have to because even if you didn't personally care to pay for homeowners insurance, you wanted to roll the dice and just take your chances that nothing would ever happen to your home. If you had taken out a loan to finance the purchase of the house, let's say the house is $200,000 and you only have $10,000, right? And you put down that $10,000 as the down payment for your home, and you financed the remaining $190,000, and you financed it through a bank. Well, both you and the bank have a pecuniary interest in that property, i.e. monetary, and you have an insurable interest, because if that house were to go up in flames, for instance, you as the homeowner you'd suffer a direct loss of your home when the house burned up. But the bank who had loaned you the money also would suffer a direct loss because your home is collateral for the loan. If the house that they lent you the $190,000 for is no longer in existence, you might stop paying the loan. And then the bank wouldn't have anything to secure the loan to get the money out of you. But when the home exists, they always have the option, because your home is collateral for the loan, to foreclose on the home and take it from you if you stop paying, so that they could recover the value of what they lent to you. So until you pay off the bank for your house, both you and the bank or finance company have a direct interest in that home. They want it to continue to exist until you pay it off. You want it to continue to exist because it's where you live and you owe money on it. So what does that mean? If you get a loan for a house, the mortgage company, the bank, whomever you get your money from, is going to make a requirement of their loan that you get homeowners insurance on the home. And many banks will say you must list us as a beneficiary on that policy until you pay us back. So if you got a 30-year mortgage, after 30 years, then the homeowners, the bank, would come off of the policy. Now, if you're in a position where you can pay for your home without getting a loan, not needing financing, you've got the money you've got the whole $200,000 in your bank account, and you pay for that house cash. And I mean literally cash, but you would, have a direct deposit withdrawal out of your account, right? If you did that, which some people do, you technically would not have to get homeowners insurance. It would be up to you because you wouldn't owe anyone for the property. But you personally in that situation still would want to get homeowners insurance, because if anything happened to your home, you would have to absorb 100% of the loss if you don't have insurance. So if your house caught on fire and it burned down, you would just have nothing and you'd have to start all over if you didn't get homeowners insurance. Or a neighbor comes over, they slip and fall on your front porch, suffer head injuries. They're going to sue you for that. If you don't have homeowners insurance, you're going to be paying any judgment they get out of your own money and savings. Conversely, if you have homeowners insurance, your policy could pay. And we'll talk about what kind of loss is covered under homeowners insurance in a few minutes. So that was a long example to show you that more than one entity can have an insurable interest in your property. I gave you a residential personal context, but it also happens in businesses. Many businesses have buildings and property that they financed. Well, the bank or finance company they used also has an insurable interest in their business facility. Maybe it's their warehouse. It could be any manner of things. And so in that case, both parties could want to have a policy on that property. Now, as it relates to life insurance, the beneficiary must have an insurable interest when they purchase the policy in the person whom they are insuring. People don't like to think about life insurance. Sometimes people don't like to get life insurance because they think it means they're thinking about their death. But I'm telling you, it's a smart thing to do. Get it when you're young, when you're not even thinking about, death being an issue, because then you have it. Who could suffer from the loss of your death? A spouse, your children, your parents. These are the people typically that you're thinking about. And we'll talk about life insurance some more in the future. But also, this is something you probably would not have heard from, but businesses also get life insurance policies on employees. Typically, this is reserved for what is called, quote, key employees. So, I've used Samsung so much during our class. Let's talk about Samsung. Samsung has some top leaders in their company, the CEO, the CFO, right? People who are leading the business, and the company could determine if the CEO were to unexpectedly die. it would leave our company in a really precarious situation, and we might be struggling to figure out what to do. So, and it could cause us financial loss. So your business can take a policy out on you as a key personnel. Some businesses do this for all officers of the company who reach a certain level, and they have key man policies. Now, who is the beneficiary of that policy? Not you or your family. Obviously, it wouldn't be you because you would be the person being insured. It's not your family either. The beneficiary of these type of key man policies is the business. So Samsung would take a policy out on its CEO. If its CEO died, the insurance company would pay Samsung upon the death of its CEO. And so that's how that works. This is very common. And as I said, a lot of businesses do it once you reach officer level. I actually had one taken out on me when I think I might have told you, I worked as in-house counsel, assistant attorney, assistant general counsel at an insurance company here in Greensboro. And at one point, I reached officer level, and they took a policy out on me. I thought it was it was sort of weird. It was like, wow, okay, they could profit from my death. Also, it was sort of a mark of, gosh, I've made it to a certain level that they think that my not being here would impact the business. Really, it was just because they had a policy across the board to take out insurance policies on people who reached a certain level within the company. But it was an interesting moment in my life. So some of you will reach that point as well. Alrighty. What becomes part of the contract? And as you've heard me say several times already, the insurance contract is typically referred to as, quote, the policy. It's a contract just like any other contract where you had to have an offer and an acceptance, and it's got the, all of the essential elements that we learned in legal environment, but it's known as the policy. Now, when you take out an insurance policy, there is an application. And the application part of the contract is getting information about the insured, the individual or company that is going to receive, the policy, who's paying for the policy. But most insurance companies have qualifiers. They have conditions that have to be met. They want to know how much risk they are taking on. So, for instance, in the context of a life insurance policy, the application is going to ask you how old you are, how much do you weigh, how tall are you, have you ever smoked, what kind of health conditions do you have. Now, some people find these questions invasive. Why do you need to know that? Why do you need to know how much I weigh? Well, because insurance companies have people called underwriters, and some of you might end up working in these kind of jobs, who run risk analyses and determine who is at risk of dying under certain circumstances in certain time frames. And they have determined that issues like weight, where you live, whether or not you smoke, family history will impact how risky you are to insure. Now, on the one hand, you might think, well, life insurance, everyone is going to die, so what difference does it make what my risk factors are? And that is true. That is an inevitable policy, right? That they will probably pay on. But insurance companies build into the risk by charging you more. If you have factors that increase the likelihood that your policy will be paying sooner rather than later, you're going to pay more in premiums. And this feature is a part of all contracts, not just life, but also business policies that we'll talk about. Depending upon what kind of business you're in and what the risks are, that increases the likelihood that you may make a claim on your policy. And Insurance companies want to know that because they're running a business. And even though they are under their contracts promising to pay you if a certain risk occurs, they would like to make insurance policies with people who are less likely to incur the risk that they are insuring. They don't want to have to pay, essentially. So if you have circumstances in your business or in your personal life that make it more likely than not that you're going to be seeking coverage quicker, or getting payouts on your policy sooner than other people would with their business, they're going to charge you more. And so that's what the application part is capturing. And because the application part of the insurance contract is assessing your risk and determining what risk factors you have, if you are false, if you misrepresent, if you lie, if you don't disclose all of the correct answers to whatever is in your application, if the insurance company finds out within 2 years, they can cancel your policy. And that's what this first part is talking about on this slide. The application is part of the contract. You as the insured, be it an individual or business, are bound by all the statements. You sign a statement saying that what the answers you are given are true. They also are going to have a statement that lets you know that if your statements are not true and they find out, your policy will more than likely be canceled. And they have 2 years within which to find out that you are not being honest. As it relates to personal policies like health insurance and life insurance, sometimes people try to hide pre-existing medical conditions. This is a common situation because people often think, well, how will they know? How will they know that I, used to smoke? Or how will they know that I had a surgery, 10 years ago? How will they know? Well, one of the things that you agree to as part of the application for insurance is the release and access to your medical records. You have to agree to that if you want to receive life insurance or medical insurance. Those things, the insurance company has a right to know your medical past because they are promising to pay you if you incur problems in the future. And so they have a right to know how risky you are. Sometimes people forget or do not disclose that their parents had things. For instance, most policies will ask you, do you have diabetes? And you'll say no. They might ask, did you have, an immediate relative have diabetes? And you might put no, when in fact, one of your relatives, your mother or father, did. And sometimes people put no because they don't know that their parent had it. And sometimes they do it because they're thinking, well, how will they know what my parents had? Well, how will they find out? Medical records. Now, they can't access your parents' medical records, but if at any time during your medical treatment you answered the question, which almost every last one of us is asked whenever we go to a doctor, for your medical history, do you personally smoke? Do you have diabetes? Did your mother or father have it? If you marked yes at any point in your life on any box to that, it's in your medical history, insurance companies will find it. So that's just a heads up. So it's better to just be honest and realize, okay, you might be paying slightly more in a premium than to try to hide it and then have the policy cancel, because insurance companies do share information. So if you are caught falsifying information on an application and you have a policy terminated during that 2-year contestability period, other insurance companies will be able to see that if you go and apply to them. So don't do it. Just tell the truth, disclose everything you know, and just realize that that's what's going to happen. All right. Now, this next provision, statutory provisions are part of the contract. What does this mean? Most states have certain requirements, certain legal provisions that they require that be found in every insurance policy. And what this means is if your insurance company fails to put that information in the policy, that the courts are going to read it in as if it were there. It's automatically going to be assumed to be part of the policy. So what are some of the key policy provisions? First of all, this is nice. You got an anti-lapse statute. In other words, you got a grace period as it relates to life insurance. If you forget or were unable to make a policy payment, you've got 31 days grace period so that your policy will not be canceled. Unfortunately, right now, some people may be invoking this. You know, if your income is drastically reduced, you don't want to spend the extra money to make your insurance payments, right? You got a 31-day grace period. It won't automatically cancel as soon as you miss a payment. Why is this here? It's for protection for insureds, because as we all know, with insurance, be it car insurance, fire insurance, renter's insurance, you pay every month whether or not anything bad happens. We all hope nothing bad happens, and so you're just infinitely paying to an insurance company. And so we consider it just unfair that you could be paying for years on a policy and then miss one monthly payment and they cancel you. So that's why this is here. Also, you can modify your contract with without having to take out a new policy. One of the main ways that people modify an insurance policy is that they add or change the beneficiary. That's one of the main ways they do it. And this can happen with property and home and life. Maybe you change the finance company, you refinance your home, and no longer your bank is no longer First Union, now the bank is Wachovia or something. You can change the name of the beneficiary, and you don't have to take out a new policy to do it. How do we interpret the policy? We've got a few tenets of contract law that we always use when we're trying to figure out what does an insurance policy mean? What does it say? So the first thing is the words and terms used in the insurance policy are going to be said to have their regular dictionary meanings, the original regular meanings, unless the terms have been defined in the policy to mean something else. So you will recall from Legal Environment, we talked about in a contract, unless you don't want, generally the words you're using in the contract are going to have their regular meanings. If you don't want them to have their regular meanings, or you want to make sure that the court interprets them a certain way, then you have a definition of terms. And if you pull out, all of you probably have at least maybe a renter's insurance policy or your automobile policy, insurance policy. If you pull that policy out, you will see that one of the first things in the contract is a definition of terms, where they define who is the insured, who is the insurer, what is the property. It's defined and described. What do terms like beneficiary mean? One of the main terms that is defined in the insurance policy is the loss. They define what it means to experience a loss. And that, we'll talk about in a few minutes, is what usually the arguments are about, whether or not an insured has experienced a loss under the policy. Now, if there is a dispute as to whether or not what has happened, what has occurred, is covered by the insurance policy, the insured, the person who is paying for the policy, has the burden of proof. That means you have to prove that there was a loss, that the loss is covered under the definition of the policy, and that you meet what the policy terms require. All right, so I'm going to say that again. If you have a dispute of whether or not something that accident or injury or thing that has occurred, whether it's covered by policy, the insured, you the person who's bringing the claim, who wants the insurance to pay, you have to first prove or put on evidence to show that you experienced a loss, that the loss occurred while your insurance policy was in force, and that the policy covers the type of loss that you had. So you experienced a loss while the policy was in force, and that the policy covers the type of loss that you experienced. All right. This seems easy. Sometimes, depending upon the insurance company and what has happened, it can be troublesome. I'll give you a quick example. Sometimes during, say, natural disasters like hurricanes, people will experience water damage to their home. And there is often a dispute with homeowners, i.e. the insured, and the company as to whether water damage is covered under their policy. Because homeowners insurance policies typically define water damage very narrowly because they don't want to cover flood. If you experience a flood, you typically have to have flood insurance. And your regular average homeowner doesn't have flood insurance unless they know they live in a floodplain. So if you have a hurricane, home is damaged, you sustain lots of water damage, you would have to show that, okay, you had water damage, experienced a loss, while the policy was in force, i.e. I've been paying my premium monthly and there hadn't been a lapse. And 3, that the type of water damage you had was covered in your policy. So usually people have to show that this water was coming in from the storm because the roof, windows, and things were broken. If the water came in because the standing water outside rose and then invaded their home, they're probably not going to get coverage. Why? Because water that's rising and comes in your home is considered a flood, as opposed to water that comes in from the sky, and it sounds crazy to say, that invades your home. That is covered under most homeowners policies, but flood is not. And a lot of people, unfortunately, find this out after they've sustained serious damage to their homes during a hurricane, where there's probably a combination of both, where they had water damage from above and then they had flood as well. If the flood is the major cause, they will sometimes be completely out of luck. And people, those of us who don't live in those areas, will watch the news and say, why didn't they just get flood insurance? Don't these people know? And it's because a couple of things. One, sometimes people don't realize they are in areas that will flood, because maybe you're living in an area that has never flooded until the storms became incredibly severe. Also, some people cannot afford flood insurance because it is typically incredibly expensive. Why is it incredibly expensive? Because if you live in an area known to flood, the insurance company knows then it is very probable that they're going to have to pay on your policy. So they charge you more because they know that there's a high likelihood that you will incur the kind of loss they're insuring. They're going to be paying you, so they're making you pay essentially for it up front by making you pay more. And so some people forego getting flood insurance because they can't afford it. Now, I'm going to make another connection, right? Because have higher risk, insurance company can charge you more. Now, I just mentioned some people would therefore try to avoid buying flood insurance because they can't afford it. You can't do that, though, if, say, you're buying a home, like a vacation home, in a floodplain, and you finance that house, because the bank who lends you the money would force you to buy the flood insurance. So I hope everyone is connecting the dots there. If there's someone else who has an insurable interest in your property, they can force you to pay for things that you might not have wanted to pay for, because they stand to lose just like you if something happens to the home. All right. So what does that tell us? The insured under the policy who's trying to get the insurance company to pay has the burden of proof that they experienced a loss, that the loss occurred while the policy was in force, and that the policy covers the type of loss that they experienced. All right. Also, I'm just going to go over this next slide pretty quickly. The contract provisions also contain that the insurer should not act in bad faith. They are liable for the damages. They're not supposed to come up with contrived ways to get out of paying you. And if you can prove that they did, you can get them for bad faith. With that said, the insured, the person paying for the policy, must make sure that they comply with the time limits on a claim, i.e., if most policies say that you have to, in alert, give notice to the insurer within a certain amount of time after you experience a loss. You can't sit around and wait, a year to let them know that your house was damaged. They've got time periods in the policy, and it is the burden is on the insurer to have read the policy and check and make sure that they're complying with the time periods. So if you have a theft at your home that was covered by your homeowner's insurance policy, but you took 6 months to finally call the insurance company, and if you read and they pointed out to you in the policy in provision 35B, section 3, it says insured shall provide notice within 2 weeks, then even though you've been paying, you would not get coverage. So the insured must comply with whatever time limits notifications are put in the policy. Now, subrogation. We're going to talk more about this during our live session, but I've talked a little bit about this before in class. Subrogation is a legal term that means your insurance company, sometimes they will pay you, and then they will bring a lawsuit against the party whom they think is really at fault for your loss, and they can do it in your name. There is a really nice chart in your book that I want you to make sure you look at that shows you how the subrogation works. And this happens, say, in car accidents. If you've got a car accident that's severe enough and that the damages are really high, your insurance company might go ahead and pay you immediately, but then they bring a lawsuit against the other driver whom they think is ultimately at fault. And they're not going to sue in the name of Geico. They're going to sue in your name. They're going to bring the lawsuit as John Smith versus Adam Powell, and to recover because they've already paid you and they want to be paid back. All right, now let's talk about different kinds of insurance. The first one also, is business insurance, business liability insurance. Every business out there needs to have this. This is not something you skimp on. Even when you're a small startup, you need to start thinking about insurance immediately. Business insurance is often known as CGL, Commercial General Liability. They are broad, all-risk policies. When I say broad, that means they can cover some of everything. They can cover your product's liability claims if you sell a product and it doesn't work, it's defective. They can cover wrongful termination. You let your employees go because they were getting old and they were slow, and they bring a age discrimination suit against you. They can cover sexual harassment. You didn't realize that your stock boy was hitting on the cashier and she sues you. Advertising damages. You make false claims or misleading claims in your advertising, and the state brings an Unfair and Deceptive Trade Practices Act against you. Employee dishonesty, trademark infringement, any kind of thing that your business runs into, this policy can cover. This is why you have it, because it covers everything. You do not want to have to come out of your pocket as a business every time you have a loss. Some losses you want to absorb, but others you want the benefit of having the insurance company behind you to help you absorb the loss. All right. I know a lot of businesses are probably tapping into their insurance right now. Now, you can also have a policy for the directors and officers, in terms of directors and officers of business, in addition to having key man insurance on their life, like I talked about earlier, you could also have liability insurance for their decisions, because directors and officers of companies can be held liable for the decisions they make. Stockholders could sue them if they don't conduct themselves in a proper manner. So you might also want to have insurance to protect their decision making. And also malpractice insurance. All types of professionals have malpractice insurance: doctors, lawyers, architects, engineers, accountants. If I, were in a situation where I gave legal advice that did not pan out, and my client thought that it was egregious and that I had just not done my research and they sue me, even though they might be wrong, I don't want to have to pay my legal expenses completely out of pocket. So lawyers have malpractice insurance. So it would come in and take care of my legal defense. And if I had a judgment entered against me that found that I had not exercised proper legal judgment, my malpractice insurance would pay that for me. And that's why we all get insurance. Don't skip it. Marine insurance. I wondered, hopefully you've all read the chapter already, right? And you might have thought when you saw this category, marine insurance, what's this about? I hope after you read it, you're like, aha, I know when I'd use this, right? All those carriers we were talking about, they were going to want marine insurance. We got two general types: ocean marine, which covers ships and cargoes internationally, and inland marine, when you're looking at domestic travel and land and inland, right? So when you were reading it, our book broke it down to, hull and cargo and risk and different insurance. I'm not going to require that you know all of that, but just generally the two types. So what is ocean marine insurance? It's liability coverage for, damage to another ship. Freight insurance covers if you've got problems that occur, the goods are damaged while you're transporting them, right? In other words, every kind of business essentially can get a type of insurance. And carriers who are moving goods for buyers and sellers would want to have this kind of insurance, right? And I imagine it would be pretty high, because we know carriers have absolute liability for the goods that they are moving unless one of the 5 exceptions is present. So if you know you have absolute liability, you definitely would want to have liability coverage as a carrier, because the odds are high, i.e. the better word to use here is the risk is high that you would have to pay someone at some point for damages. So they were going to want marine insurance. Fire and home. This is what most of us are familiar with. Now, you might not have realized that they can be separate. So fire insurance, businesses would typically be the ones purchasing fire insurance, because homeowners can get fire wrapped up in their general homeowners. It's not separate. But businesses typically would buy fire insurance separately, and then they would get their CGL, their commercial general liability insurance. So they would have both. Now, I wonder how many of you were surprised to learn that a fire can be hostile, or it could be apparently gentle. And you've got to have a hostile fire to cause damage under fire insurance. I even thought that one was new. I have never dealt with fire insurance, and find that really interesting when I learned about this years ago, that there is such a thing as a hostile fire, as opposed to, and what they mean is as opposed to a fire that you start yourself that gets out of control. So you got to be aware of that. Homeowners insurance. So when you get homeowners insurance, it includes fire protection, theft, and liability in a single contract, which is nice. So you don't need to go out and get a fire policy and then a policy for theft and then a policy for just general liability. It's all wrapped up in your one homeowner's policy. Now, it covers accidents or injuries that occur on your premises, and it extends to occupants of people of your home outside of your property. So for instance, and this is pretty neat, right? So I think we all get the accidents or injuries on your property, right? This is another reason why you want homeowners insurance. You don't, I was giving the example earlier that if your house burned down, right, you want homeowners insurance so you'd have the money to rebuild. We had tornadoes come through Greensboro a couple of years ago, and people had to use their homeowners insurance. But you can also have much more common problems, like someone comes over and they slip and fall and suffer injuries, got to go to the hospital. And even though it might be your friend or it might be your cousin, and you're thinking, well, surely they won't sue me, it may not be their choice, right? Because if someone gets hurt at your home, even though they are probably a friend or relative if they're at your home, when they make a claim to have their medical bills paid for, their insurance company may force them under their right of subrogation to sue you. And you might be angry thinking, okay, why is my cousin suing me? Well, it's not really your cousin. It's your cousin's insurance company who's suing you under their name because the insurance company wants to be compensated for the loss because they're saying it was your fault, not theirs, and that your insurance company should be paying for your cousin's medical injuries, not your cousin's insurance company. So I want you all to remember that and to realize that when, and this happens a lot of times in car accidents, when someone is injured and you will see that their estate or a guardian is suing the parents or grandparents, and you might wonder, who's doing that? That seems so dysfunctional. No, it's not a family dispute, or at least most of the time it isn't. It's the insurance company under their right of subrogation to sue the party that they think really caused the damage so that they can recover. Because insurance companies don't really want to pay. They don't ever want to pay. Why don't they want to pay? It's not that because they're just doing bad business. It's because they are insuring all of us. And so if they don't push back and make sure that the right party pays, then they'll be paying for everything and it won't be really a worthwhile business for them. So they've got to try and, apportion their risk as well. And this is beyond our discussion, but insurance companies have insurance. Yes, they're called reinsurance companies. And that insurance company that I worked for, that I mentioned a few minutes ago, was actually that type. It was a reinsurance company. We were insuring insurance. So there's many levels of this. And so when they are disputing your claim, or when the relative falls and you thought it was just going to be okay, they said they were fine and they left, and the next thing you know, you're getting a lawsuit, it's because their insurance company is trying to make yours pay. One of the nice things about your homeowners is it also will cover the people who live in your home, so long as you listed them on the policy, when you're out away from home in certain instances. Like when you go fishing, hunting, golfing, you get hit in the eye on the golf course and suffer eye damage, terrible situation. And you might wonder, well, what in the world will I do? You can make a claim on your homeowner's policy. This is why you get insurance and why you read it, so that you know what will happen. Quick story. When I was a student at A&T, I lived in they don't have these anymore, but they used to have honors houses. Actually, they were houses. It was an honors house. And the honors house had a storage shed in the back. And I put some of my, some of my clothes and things that wouldn't fit in my bedroom in the honors house in the storage unit. Well, my stuff was stolen. And, I told my parents about it. I just thought that was all to it. My parents made a claim on their homeowner's policy for the things that were stolen from the shed at A&T. And my parents live in Virginia, and the policy paid for my clothes that were stolen from the shed that was located on A&T's campus. Why? Because I was listed as part of the member of their household and their homeowner's policy. So they can be pretty helpful, powerful when you have them. Automobile. This is the type of insurance that probably you all are almost familiar with. What's covered: liability, medical expenses. It also, all policies cover you for in case you are hit by uninsured motorists and, collision damage to the automobile. I'm not going to go over this one too much. Everybody has this and everybody kind of gets this, but you've got to have it, right? And it's most states require that you show proof that you have insurance when you are when you purchase the car, and then when you get everything renewed annually, right? This concept of no fault insurance, what this is saying is that when you have an accident, your insurance company is supposed to go ahead and pay whether or not it was your fault or not. And then after the payment has been made, if the injuries or damages exceed a certain amount, then they can pursue their subrogation claims. Like if they pay for you and they really think it's the other person's fault, if it goes over a certain threshold, then they're going to bring that lawsuit in your name that I was talking about against the party that they think is responsible. Life insurance. I've talked a lot about life insurance on this call. Life insurance, there's three general types: term, whole life, and endowment. So term life insurance is the cheapest. It's the most basic. This is where you are buying insurance for a period of time, i.e. the term. And they can come in increments of 10 years, 15, 20, 25, 30. What that means is if you buy a term life policy for 20 years, you're going to pay on it monthly for 20 years. And then at the end of the 20 years, if the insured has not passed away, then the policy ends. And even though you would have paid for 20 years, if you didn't die within that time frame, you get nothing. Your beneficiaries get nothing. If you die within that time frame, then your beneficiaries get the policy amount. So let's say you take out a 20-year term life insurance for $200,000. If you pass away at year 18, then your beneficiaries will get the $200,000. If you don't pass away to year 30 and you bought a 20-year policy, you get nothing. You just will have paid the insurance company for 20 years. So that's the drawback for term life insurance, is that the insured has to pass away during the term or you get nothing. Why do people buy term insurance? Because it's really cheap and it's a good way to have some insurance rather than none if you're not at a point where you can afford more insurance. And also, if you get the time period long enough, depending upon how old you are when you purchase it, you can make it work. For example, term insurance is a good idea, can be a good idea. Let's say you're young. Let's say, it could be somebody in class, and let's say you have a child and you're not really making that much money yet. But if if something were to happen, you want your child to be taken care of, then you could get a really cheap term life policy for say 15, 20 years, even 30 now while you're young, and you could get a $500,000 policy. If something were to happen between now and year 30, your child or spouse or whomever you list as your beneficiaries would get $500,000. That could take care of your child and your spouse. They wouldn't lose their home. They would have a way to take care of themselves until they got back on their feet. And so term life can be a good idea when you don't have a lot of money to spend on a whole life policy, but you have people that you want to protect that you wouldn't want to leave in a in a precarious situation. So term life is a good thing to start with until you make more money. And as I said, they can be very cheap, and you probably see them advertised on television. Parents sometimes get them on children. If something were to happen and you can't afford, the arrangements for your child if you didn't have a policy. So lots of companies sell really inexpensive policies on children. These are not, topics that people like to discuss, but they really are inevitable. And it behooves people, particularly if you have children, you need to have a policy so that there is something to take care of them if something happens to you. Um, and it's really just kind of a way of saying, I care this much about you that I want you to be taken care of. And so, you get the policy, you get a direct um, withdrawal from your account every month, and you forget about it. It's not going to accelerate anything that wasn't going to happen. All right, whole life insurance. Whole life insurance is much more expensive because it does a lot more. With whole life, you are paying, and the premium builds up as in value, and there is no term limit. So if you get a policy and you pay on it for 30 years, no matter when you expire, the policy is going to pay your beneficiaries. There's no limit on the time period that it would cash out. So it's a policy that once you pay for it and you continue to pay for it, it is guaranteed that your beneficiaries are going to receive something. And they some people use them as an investment tool that you can build up value and use them to finance things. That you need to confer with your insurance professional for that, but they can be used as an investment tool. All right, an endowment policy also has a defined period, but it's more expensive, and it will pay even if the insured is still alive when the policy period ends. So this one's sort of a hybrid between term life and whole life. It's going to be more expensive than term life because you're definitely going to receive the money no matter what. And under this policy, the insured themselves, if you get the endowment policy and it's 10 years, and at year 10 you're happily still alive, you get the policy amount, the face amount of what you paid. So you do get money. It's not wasted. Then this last feature is called double indemnity. Double indemnity is you get twice the face amount of the policy. So you pay double, the insurance company is going to pay double if there's a death due to an accident. Some policies have that. So you could have a life insurance policy that says in the event of an accident, you get double the face amount. So if you had a $100,000 policy, you get in $200,000. If you went for the $500,000 policy I mentioned, your beneficiaries would get $1 million. If you get $1 million policy, which people get and you can get if you get it early enough in your lifetime that it doesn't cost you a fortune, that means it would pay $2 million if your death was due to an accident. But most of these double indemnity policies have exclusions of what kind of death it can be, and there are a lot of them. You'll see them listed in your book. But for instance, if the accidental death is caused by serving in the military, by being shot by someone as in a crime, or there's something else, or also a disease, you don't get the double indemnity. So you kind of end up wondering, well, under what circumstances could you get the double indemnity? Usually it's something like they're talking purely an accident, like a car accident, a physical injury or something like that. But if you're the victim of a crime, if you're in wartime, or if you die from a disease, the double indemnity does not pay. There's also disability insurance, which I am being told by professionals most of us need to get, because now with our medical advances, people often survive most accidents, but then they have to suffer with disability and are then no longer able to work. And so disability is an area of insurance that's exploding, and that more people are getting because more people are living longer, but they're not necessarily capable of working while living. All right, we're almost at the end, guys. So remember that double indemnity is not, oh, I should have told you Suicide is one of the main reasons you can't get double indemnity. Narcotics, the intentional acts I told you about, and war. The beneficiary. I think we all probably know this, but the beneficiary is the person who's going to receive the proceeds on the insured's death, and the insured has the right to change who the beneficiary is, and they don't have to ask who the beneficiary. It's probably a good idea not to tell your beneficiaries, years in advance that you've got a policy and that they're going to get money from it. Just to kind of avoid any family strife. All right, last slide. The incontestability clause. I kind of hit on this earlier. Generally, most states provide that insurance policies have a 2-year incontestable period, right? So your insured company has got 2 years to investigate and ensure that everything that you claimed in your application is accurate and truthful, and that no fraud has occurred. After that time period, even if the insurance company finds that you committed fraud, that you went out of your way to lie to get that policy, the insurance company can't do anything about it. And they're going to have to pay on the policy the way that they promised to. Alrighty. So I hope this has been helpful to you. Now you may want to go back and reread the chapter now that I have condensed it. These are the things I'm looking for. There were lots of details in this chapter, but this is the nuts and bolts. Again, I wanted us to pivot and look at insurance because insurance really does enable businesses and individuals to take on risk that they ordinarily would not be able to do. And as I hinted at, and maybe we can talk a little bit on our live session, even insurance companies have insurance. Alrighty.